Here's Vaj on the line in Montreal. Hi there.
Hi, guys. Thanks for having me.
Sure.
I'm interested in buying utilities Enbridge for my portfolio.
All right, Enbridge, what do you think?
So on Enbridge, this is a part of the market that we really like, core energy infrastructure, and Enbridge is one of the most disciplined companies in this space. They're very financially disciplined when it comes to the projects that they undertake. It's a company that is going through a significant pickup in growth. They've got a lot of projects underway, and that's going to help them grow their cash flow. Anytime a company can come out and say, we will raise our dividend 15% a year for the next 5 years, they're pretty confident. Companies are very careful when they talk about their dividends. Now, that speaks to something that I think is really important in this market. We have a group of investors, both institutional and private client investors, who all are looking for some certainty in their return. Where you do the best over time is not just getting a good dividend, but getting a dividend that's reasonable, but that will grow over time. So this combination, I think, is really attractive. And in the case of Enbridge, you're seeing Enbridge get revalued by the market. Historically, energy infrastructure was low single-digit growth with a good yield, a fixed income replacement. They have become a much more growth-oriented group that still generate very strong cash flows, so you get the best of both worlds. You get yield plus dividend growth, and I think that's why the stock's acting as well as it is in the market.
Holding up really well. So buy it here?
I would buy it here. Now, we own it, and we continue to buy it, and I keep having people tell me they're expensive relative to history, but these companies are in a different environment today than they have been over the last 20 years. There's a much higher growth rate.
All right, good point. Here's Tony, as we stick with energy in Toronto. Go ahead, Tony.
Thank you for taking my call. Dave, last time you were on the show, you said you were short CNQ. Are you still short CNQ, or is it a good entry point?
So, yes, we are still short, and I think that we are getting down to lower levels. We're short a couple of others as well. The problem is the oil sands folks are having a hard time getting the right price for their oil with the bottlenecks in the system. The other problem that CNQ has is they have like 30% of their revenues coming from conventional gas assets, which is not attractive in the market currently. These are the problems. The last problem is, of course, the cost of getting some of their new projects done, and there's always questions around that. So at this point, with the price of oil backing off, that's just the extra nail in the coffin right now. You don't necessarily need to step in front of this one yet. There will be opportunities. It's okay not to get the bottom. It's okay to buy them, 7 or 8% higher after they show you some meaningful turn. But I think they'll need to base a little bit before that happens.
Do you ever nibble away on stocks? Would you recommend easing into something?
We do. We always start with a partial position. But we only start with partial positions when we see price behavior in the market that supports our view.
Right.
So not in a falling tape.
Okay, then here's Ernie, who's in Calgary, as we go to precious metals now. Hi, Ernie.
Hi, how are you?
Good, how are you?
Excellent. David, just a really quick question in regards to silver. I heard your comments on silver wheat, and I'm looking to find out if Silver Corp Metals is a good entry point at this point. They've been having some short and distort issues, and I think they might be bucketed into the Sino-Forest type world into China, so I just wanted to get your thoughts on that. And I'll just hang up and listen.
Yeah, whenever there's smoke, we stay away. I think this is one you don't need to be in. It's come down from 16, it's 5 and change. It's broken some significant support in the high 5s. I think there's better places to look.
All right, John's in St. Julien, Quebec, with a question for you. Hi, John.
Good evening, gentlemen. David, my question's more on the technical side with Bombardier. It seems the top end of the trading range is around $6 through the breakthrough. Like the market indexes, it seems that it's done very little for the last 10 years. So my question is, would you wait for that breakout on the $6 range, or would you turn around and buy it in the $4 range now, $2 discount to that price? Thank you very much.
Okay. So this is one this is a great stock to talk about, because, as you know, from the late 80s to the late 90s had a tremendous run in this stock.
Yep.
And why is that? Not only were they getting earnings growth, but they beat the quarter 24 consecutive quarters in a row, and in process went from trading at 7 times earnings to trading at 30 times earnings as Canada's greatest growth stock. It became a stock that everybody had to own, And then finally, they started to miss the earnings. And once that started, not only did the earnings fall, but the earnings multiple people were willing to pay compressed, and you got a long sell-off. So this company has gone through that long sell-off. I don't think we are at the point where you're seeing a significant operational improvement, and technically the stock is still basing. At some point, there will be an opportunity. I would like to see the stock trade through $5, which I know is a way away from here. And I'd like to see some evidence that the financials are getting better. You've had 3 quarters of revenue growth recently. That's good. Stock's just not responding yet.
So you want to see it above 5 then?
I'd like to see it above 5, but it's based out for a long time. It certainly could have a significant move at some point, and it's one you want to keep an eye on.
And we kind of forget about that fantastic run Bombardier used to be on. That's going back a long way.
Well, yeah, but it takes a long time for that over-ownership to be washed out into the market, and the multiple to get compressed. So, it's trading now at about 8 times earnings. It's not that expensive. But I think you need to see the operational piece kick in and the technical piece get a little better.
Yeah, it brings to mind Ron Meisels, who we have on the show sometimes, and he loves long bases, multi-year bases, and then he sees a breakout, and that's when he likes to get into certain stocks.
Well, we'll talk about a couple tonight.
All right, perfect. Very good. Let's take a short pause here again with David Burrows. We'll get back to the calls and emails after this.